Welcome to another episode of Taking Stock for the week ending the 15th of May 2026. I'm Kien, Trinh, Head of Research at Stock Doctor. And joining me today is our Senior Analyst, Jason Yin. Welcome aboard, Jason. Great to have you on again.
Thanks, Kien. It's always a pleasure.
Always a pleasure having you. But just before we begin, a reminder that today's discussion is general in nature and won't consider your personal financial situation. Also, a reminder that we have our Sydney and Melbourne Masterclass events next month, where we take investors on this journey, focusing on asset allocation strategies using shares, ETFs, properties, and alternative investments. So make sure you sign up if you haven't done so. But Jace, markets have remained quite volatile this week as investors weighed the Australian federal budget, the US-China summit, and ongoing geopolitical tensions in the Middle East. Oil prices, they remain elevated while confession season continues to expose pressure on those companies that aren't, holding on very well.
Yeah, there's a lot of complexity happening across the macroeconomic front, and that pressure is clearly flowing through to earnings. Temple and Webster downgraded guidance this week after weaker consumer confidence impacted sales, while Babcock blamed rising fuel and freight costs for another earnings downgrade, which was rather disappointing. Even Life 360, despite lifting revenue guidance, was also sold off because user growth disappointed market expectations.
Yeah, quite a minefield out there, Jace. But the federal budget, that also added another layer of uncertainty, particularly around the housing market and investor sentiment. Proposed changes to capital gains tax concessions and negative gearing, that has raised concerns about slowing mortgage growth and potentially could impact banks and those property sectors.
Yeah, on the fiscal front, there is a lot of complexity building, and there are concerns amongst most investors. But from an equities perspective, the broader message is that the budget seems to be a shift away from tax-driven capital growth strategies and more towards income-focusing investing. Investors are no longer rewarding companies simply for growth. They want earnings quality, visibility, and also evidence that margins can hold up in a tougher operating environment. And that's why stock selection, can, and risk management remain rather critical from here.
Yeah, especially with financial health in this type of environment where cost inputs are rising. But let's start with the banks now, because Commonwealth Bank, they came under heavy selling pressure following their third quarter update. Now, the result wasn't disastrous, but expectations were extremely high given CBA was trading at a premium valuation, not just to history, but also relative to its global peers.
Yeah, the sell-off was rather aggressive, Kim, but the broader issue is that earnings momentum across the banking sector is slowing. Quarterly revenue growth trends have softened, and also competition in mortgages remains rather intense, and bad debts are beginning to rise from very low levels. Investors are questioning whether banks deserve premium valuation multiples if credit growth slows and the economic backdrop deteriorates.
Yeah, and the timing wasn't great with the budget announcement, with the federal budget potentially adding another layer of risk. Proposed changes to those property-related tax concessions could weaken investor demand for housing and then reduce long-term mortgage growth, where CBA is particularly exposed relative to some of the other banks.
Yeah, you were the analyst on that note, Kay. What do you think about the best performing bank overall?
Well, Jace, in terms of banks, they all kind of are very correlated, but ANZ probably delivered the strongest overall result this reporting season. Management did prioritize returns over aggressive loan growth, and their costs were well controlled, and bad debts remained relatively low, where provisioning, especially for the other banks, started to rise.
Yeah, that's interesting. I mean, on the other side of the spectrum, NAB and Westpac appear more vulnerable if economic conditions worsen. NAB's result was particularly cautious with rising bad debts and also weaker returns and concerns around capital generation. Westpac had also materially increased its risk appetite, and the business lending exposure at a time when economic risk is rising could be a cause of concern in future.
Yeah, that's a very interesting strategic move by Westpac. But regardless, for now, we believe that bank dividends remain sustainable as long as unemployment rates remain quite low. But moving now to gaming giant Aristocrat Leisure. Aristocrat, they delivered a solid first half result with the stock rising around 13% on the day. So what drove that strength?
Well, earnings was a slight beat against expectations, and management did reaffirm full year guidance.
Mm.
Investors also found a bit of comfort in the core gaming division. Casinos are still buying Aristocrat's pokie machines at healthy levels, and the company continues earning reoccurring revenue from the machines that's already installed onto casino floors, which is also a positive. This creates a very stable earnings base and reinforces Aristocrat's position as one of the highest quality gaming businesses globally.
Yeah, and with it being a high quality business, Jace, I mean, a few investors would be questioning why the share price has been in the doldrums over the last year, but that's because investors became concerned about growth and how that's slowing. I mean, in its digital gaming division, that delivered a weaker profitability than expected, and mobile gaming growth also could that be maturing as well? And there were concerns around Aristocrat spending aggressively to expand that online division.
Yeah, that's right, Ken. I mean, the online segment saw exponential growth during COVID, where everybody was tied up at home playing computer games, and as COVID subsided, you do see a moderation on that component. So it is expected, but we come to the valuation debate, and that is becoming even more interesting. Expectations are very much lower as they were a year ago, and if management can prove the digital business can continue to grow earnings momentum without hurting profitability, I think there's likely to be some upside from here.
And for under the microscope this week, let's turn to healthcare giant CSL, a stock that you've been covering for a while, Jace, and it has continued to disappoint investors. The company downgraded earnings guidance this week, but realistically, the warning signs were already there after the first half, where earnings missed expectations by around 7%, yet management still maintained their full year guidance back then.
Yeah, and therein lies the concern, Cam. When a company misses expectations earlier in the year, but kept a full year guidance, the rest of the market thought it was a little bit of a stretch that second half could actually make it. And lo and behold, with a new interim CEO, he had an opportunity after 3 months to effectively dust the slate clean, and release a new downgraded guidance. And that's been the difficult part. There was several parts of the business that's already under a bit of pressure, and that's why we saw the price react so aggressively.
That's right. I mean, those pressures were very broad-based, wasn't it? I mean, you've got costs to collect blood plasma in the US that remains elevated, and also pricing from albumin products in China, blood plasma therapy that's used to treat critically ill patients there that remains weak, and then flu vaccine demand that's softened after several severe flu seasons. And its iron deficiency business in Europe that's facing more competition. So, despite all of that, why have we retained CSL?
Yeah, I guess if you were to ask a Charlie Munger type, it's the company is experiencing a Lollapalooza type of an effect where everything bad is all happening at once. But there is a very important distinction between cyclical execution issues and also permanent structural impairments. And we don't think that CSL is going through a permanent structural impairment. In fact, the company has gone through periods like this before. The franchise itself remains incredibly strong. The plasma demand side of the business, yes, that does look temporarily rather weak, but there are growing I guess demand thematics over the longer term, which should aid the earnings growth of that segment. And CSL does have a global scale advantages and are difficult to replace their manufacturing and also R&D capabilities. So we still think that the company, from a valuation perspective right now, a lot of the bad news have already been reflected in the share price after that substantial derating from historical levels, and at around 10 times price earnings. Yes, there is value, but we've also said there was value at around $200 or so. The only thing right now that the company needs to get right at the August results is at least give investors some form of confidence that this is not a structural impairment, but a temporary lull in terms of their earnings trajectory.
Yeah, thanks, Jason. And I'm comforted by the fact that they've done an earnings reset. And so, from that basis, I mean, do we see long-term opportunity from here, or are there still risks still lingering with this business?
Yeah, we've sort of identified a couple of goalposts that we want to see at the FY26 and a result in August. I mean, just broadly speaking, the key risks are obviously around US healthcare pricing reform. You've got Medicare Part D changes that could create further weakness. You also have a situation in China where albumin pricing has been down 10 or so percent, but volumes are increasing. So that looks like it's semi-structural, but it's something that's across the whole market and it's not idiosyncratic to CSL. And then, of course, you've got the Securus separation that we have seen that could create a little bit of uncertainty with how that sort of plays out. But ironically, Kien, Securus was the better performing segment of the group in the trading update. So, that managed to carry the group forward. The probability is that in any type of environment, if there was a rebound and the goalposts are met, then you could see a pretty sharp recovery in that share price.
Yeah, definitely. I mean, the focus now is on whether that earnings momentum begins stabilizing over the next 12 months. Investors wanting stronger near-term earnings visibility, though, may prefer businesses like Pro Medicus or ResMed, while CSL remains more of a longer-term recovery opportunity from here. Now for question of the week, which focuses on the federal budget. And the question is, which stocks could be impacted by the policy changes?
Yeah, I think that the clearest losers out of this can is obviously housing. Changes to negative gearing and also capital gains tax could reduce investor demand for established property and creating potential headwinds for banks like CBA, ANZ, NAB, and Westpac, and also potentially for REA as well, which relies on property listing volumes to drive earnings growth.
Yeah, but the budget also creates offsets as well. You've got healthcare. That was a relative winner with increased hospital funding, more support for PBS and urgent care clinics, and also no major cuts to imaging or pathology. So that's broadly supportive for names like Integral Diagnostics.
Other winners include defense care, and with spending largely protected and also additional funding being committed over the next decade, this does support the broader defense ecosystem, which could include businesses like Codan, Duratec, Austal, and also ServiceStream as well.
Yeah, and also on the negative side as well, you've got private health insurers like Medibank and NIB. They may face pressure from changes to age-based rebates, while reduced electric vehicle incentives could become a longer-term headwind for novated leasing and fleet-exposed businesses like Macmillan and Smart Group, although the one-year extension of the EV rebate should provide some near-term support for these businesses.
I think overall, the key takeaway for investors is to avoid the noise and the headlines and to focus effectively on making money. Markets react to news rather quickly in the short term, but over the long term, everything moderates and returns are still driven by the quality of the underlying businesses, the profitability, financial health, competitive advantages, and also management execution. So those are the key things to focus on.
As famous investor Benjamin Graham once said, in the short term, the market is a voting machine, but in the long term, it is a weighing machine. And that brings us to the end of this week's episode of Taking Stock. Once again, thanks for your insights, Jace.
Thanks for having me, Ken. It's always a pleasure to be here.
And also, thank you to everyone for joining us. Until next time, have a happy, healthy, and prosperous week ahead.